Welcome back, everyone, for the afternoon sessions. Just a very quick bit of housekeeping before we proceed with the next speaker. For those of you joining us afresh in the afternoon, if you want to participate in the polls or if you want to ask any questions from the panelists, please do register on bbgevent.app/ESG Invest. And once your details are in with the Wi-Fi codes on the back of your badges, you can then participate in the polls, ask questions, and the panelists will do their best to fit them in. But now I would like to introduce Rob Barnett. He is a senior analyst and BI sector lead for energy and commodity research in London. Today he's going to present BI's outlook for oil and European carbon allowances, including the read across for clean energy demand.
Thank you. I hope everyone had a great lunch. This is my first time speaking at an in-person event in over 2 years. First time wearing a suit in that amount of time as well. Thank God it still fits. Bear with me if I'm a little bit rusty. But a lot has happened over the last couple of years. Just yesterday, one of my colleagues had an article on Bloomberg talking about how finance professionals here in London have seen their wages increase 31% since the start of the pandemic. Congratulations, by the way. But if you think 31% is impressive, let's take a look at the carbon market. We've gone from roughly 20 euros a ton here in Europe for carbon pricing to 80, 90 euros a ton. Some might describe this chart as a hockey stick even. Now, I know hockey sticks are really bad if we're talking about carbon emissions, but I think you can think of them as transformational if you're talking about something like CO2 prices. Now, I cut my teeth early in the SO2 and NOx trading programs in the U.S., the grandparents of carbon trading here in Europe. And when I see a chart like this, I have two questions that really come to mind. One is the rise that we've seen structural or not. I'm going to make the argument that it potentially is. And then the other question is there more upside? What are the drivers? And that's a bit more complicated. So before we make any broad conclusions about the CO2 market, I think it would be useful to frame it against what's going on with commodity markets in general. I'm showing the change in prices for carbon, oil, and Bloomberg's broader commodity index here. The carbon price is the one at the top since the start of 2000. It has gone, or 2020, excuse me, has gone up 4x. Oil, a very close cousin of carbon and a contributor to emissions, has gone up about 3x. Our broader BCom index is up about 2x. So generally, what is going on here? I think it's the same basic story for the physical commodities. We had underinvestment during the pandemic, reduced supply. Now, some would argue that there was underinvestment in the lead up to the pandemic as well, but we've got a supply-constrained set of markets. We've got resilient demand. As we get life back to normal here, we're seeing oil demand, gas demand, which translates into demand for carbon credits, and the cap sectors in Europe come roaring back. And if you throw in a little bit of geopolitics as well, this is the place that we're going to land. Now, some might call what we're seeing here a super cycle. Indeed, my colleagues who are hopefully here in the room, Sally Ilmez and Will Hares, have a note arguing that we're in the midst of a $100 a barrel super cycle for crude oil. But the word cycle implies that it's not going to last forever, at least in the context of oil. While we see many near-term bullish factors, longer term, when you look at oil, we're going to see challenges from electric vehicles that call into question what demand looks like over the next decade. And I would also note that the long-run marginal cost, depending on who you ask, but they're generally perceived to be a bit lower than where we are today. So potentially a super cycle for oil, but if you go back to carbon, a little bit different set of fundamentals. So I'm going to rewind here and go back and look at the carbon market and give you a sense of what was going on. So we were pretty flat from most of the last decade. And when you think about that, why was it so interesting? Well, bit of a history lesson. If you don't know what was going on in the carbon market at the time, the European government set the cap up here, but emissions were down here below the cap. So we were in a structural oversupply. Every year, there were more allowances than were needed. We were essentially building up a bank of unused credits. So if you have a carbon allowance, you don't use it in one year, you can save it and use it in a future year. And now policymakers weren't exactly unaware of this, and they made some changes in the last couple of years that have helped contribute to this potential structural increase that we've seen during the course of the pandemic. A couple of nerdy terms. So the first one is Market Stability Reserve, MSR. Basically, the governments are withholding allowances that they previously would have auctioned to help tighten that cap and reduce the supply of allowances. So restricted supply, bullish for prices potentially. There was also a big policy change that came out in the pandemic. It's called the Fit for 55, and it is not the exercise regime that I should be on. It is the European Union's goal to reduce emissions about 55% by 2030, which implies a lower cap for carbon emissions as you go through time. Now, our assessment is that the European carbon market is going to be in a deficit this year by about 100 million tons. Now, there are banked credits that can help cover that deficit, but we're essentially in a market where we're tapping the inventory of banked allowances to cover current emissions. And next year, all things being equal, the cap's going to get a little tighter. The year after that, the cap's going to get a little bit tighter. So it seems structural, but there are a lot of caveats. So the next 12 months is going to really hinge on geopolitical factors, particularly here in Europe. And if you look at the Russia-Ukraine crisis, we've got three scenarios that we are using to think about commodity markets in general. This is probably a bit small for anyone in the room. We can follow up and show you the detail if you're interested, but we've got an ease scenario. So the conflict gets a little bit, we find a resolution. We put the genie back in the bottle. This is potentially going to be something that takes the fossil fuel commodities and help them get some sense of normalcy. So lower oil price. Under our extend scenario, we stick around with roughly where we are today. And under our escalate scenario, oil prices could go quite a bit higher than where they are. Same kind of thinking for gas and some of the other physical commodities. CO2, however, is a commodity that we think would or could work in reverse. You could generally think of it along the idea that war is bad for emissions markets. And there's some fundamental drivers here. So the first one is that if oil, gas, coal, etc. get more expensive, we're going to use less of them. Under an escalate scenario, there's probably reduced economic activity, reduced steel production, reduced cement production, the kinds of things that produce emissions that are capped under the ETS, and so you potentially see lower demand under an escalate scenario. I also think under an escalate scenario, there is increased risk for a market intervention by policymakers. Lawmakers in Europe don't have too much control over the flows of gas from Russia to Europe or Vladimir Putin's behavior, these kinds of things, but they can influence the European carbon market, and under dire conditions they may choose to do so. So, commodity markets potentially have some upside if we are in more of a conflict situation. Now, where does the rubber meet the road? This chart shows the levelized cost of electricity. If you're not a utilities analyst, maybe you've never seen this kind of thing before, but this is a long-held way of thinking about what is the cost of adding an incremental electron to the grid. And the blue bars and pink bars are roughly where the thinking was for this kind of thing prior to the big rally in commodity prices. And the conclusion one could draw from this is that solar and wind are the cheapest electrons you can put on the grid. They were the cheapest prior to the big extreme run-up in commodity prices we've seen. And the commodity run-up would take those pink bars and push them up to that range shown in orange there. Wholesale electricity prices in Europe are consistently in certain markets over 200 euros a megawatt hour since the invasion of Ukraine. So if you were using spot pricing, the case for wind and solar is even more profound. In fact, I don't think it's ever been stronger. So we are seeing a world where carbon prices are high. They're 4x what they used to be. Gas prices are high. Oil prices are high. And this is just driving clean energy demand up and to the right. So how can you use this kind of knowledge? A very quick anecdote. Vestas is one of the companies that we cover. We cover about 2,000 companies in BI. They are the world's largest wind manufacturer. I'm sure given the focus of everyone in the room, you are familiar with them. Very interesting view on the company when you look at consensus. So on the left-hand side, you see the company's historical turbine deliveries, and you see in the blue bar what consensus thinks they're going to do over the next few years. In the orange bar, it's a potential scenario that we've laid out for the company. So consensus is essentially flat. We think they can grow turbine deliveries given elevated commodity prices and the pressure to both decarbonize and provide energy security at a much faster pace. And this has implications for EBITDA and other financial metrics. This is what we would call a focus idea, which are our highest conviction, most differentiated calls, i.e. they diverge from consensus. And we've got a PDF that you can download via this little QR code here and take a look at our report if you're interested. I want to conclude with another idea that's related, arguably another hockey stick type chart. Now this is showing wind and solar demand, the number or the gigawatts of installations that are happening each year. I would like you to just allow your mind to extrapolate what is next. This is purely the history here. There's no forecast. EVs look similar, by the way. And then layer on elevated CO2 prices and think about where this might go next. Layer on elevated fossil fuel prices, and we really are ending up in an interesting world where we've got expectations for booming demand for wind, booming demand for solar, but there's also an all of the above element, because we're, at least in the near term, in a world where we are seeing robust oil, gas, coal pricing, and robust demand for those as well. So we're going to have to see how it plays out, but it's not a pure ESG reality, but it's also not necessarily a set of alarming conditions for an ESG investor to imagine where this is going. So if you like what you've heard, I'd encourage you to Visit our dashboards the next time you fire up your Bloomberg terminal. You can certainly feel free to shoot me an email if you've got questions about any of the ideas I've talked about. Say hello on Twitter or LinkedIn, or come and shake my hand during one of the breaks. I look forward to speaking to all of you. Thank you very much.